Hello, guys. Thank you very much for joining in. We're going to be starting out with this chapter, which is Beyond LIBOR. Okay. Now, the basic context about this chapter is that we are going to discuss about what are the problems that the market anticipated and identified in the LIBOR as a risk, as a reference rate. Okay. And then they decided to move away from LIBOR and they are looking out for other alternatives. What all alternatives were available and what are the major challenges that they face when you look at each alternative, and further, as a risk-free rate, okay, which are the key parameters that market look for, or as a reference rate, which are the key parameters that the market look for to identify in a rate, in a reference rate. Okay, so that is the basic part. So if you read this first paragraph, first line, they are talking about benchmark rate. Okay, so LIBOR, which is being used as a benchmark rate, what are the challenges and how we are moving away from it. So that is the context of the chapter. So if you look at the first module gives you a view of ideal reference rate. Okay, ideal reference rate means what are the qualities that we should expect from a reference rate from that perspective. Now, first of all, IBOR is interbank offer rate. Okay, this is a rate basically which is used by market participants to raise money from each other. Okay, from one bank to another bank. Okay, that's the most widely accepted benchmark rates in your transaction. And LIBOR being a London interbank offer rate, it was widely used because the London market is very active. Okay, so currently the IBOR have many desirable characteristics and widely accepted as a rate for a benchmark. Okay, but recently we have seen this is a very important part, the manipulation. Okay, so manipulation explicitly happened in LIBOR, and we're going to be talking about that also during this chapter, which led to the question that whether we should use interbank rate as a benchmark rate or not. Okay, so ideally, the three ideal reference rates, or three ideal features in the reference rate is been highlighted over here. All three are important. Mark them as star. Okay, the first being whatever rate that we are looking at, those rate should come from an active liquid market. What does that mean? The transaction between the banks should be very active, and that transaction market should determine the rate. For example, if you go to stock market, you see a lot of people trading, and when you see a lot of people trading, it's a liquid market, and because of which the price of the security is determined. Because if I wish to sell at 90, there has to be somebody else who's willing to buy at 90. That leads to the creation of market. Okay, so the more active market is, more liquid marketed is, the price or the rates that we are looking at, those are accurate. Okay, they become very relevant because that is what the market participants are quoting. That is why active liquid market is very, very essential. That's a very first feature, and this is also a feature of a securities market. Okay, so if you are looking at stock market, one of the strong features is that you can actively see the price because participants are quoting their price, and on the basis of which trades are happening. Okay, the first point is that. The next point, this outside money market section, the rate is able to offer a reference rate outside for financial contract outside the money market. What does that mean? See, we know that LIBOR as a rate, it has been also used in swaps, in a lot of caps, in a lot of interest rate derivatives also. Okay, so what happens is, it is not that rate should not only be applicable to your interbank lending part. It should also be used, it should have features to be used as a rate, as a reference rate in other financial contracts. Then it becomes widely acceptable. Okay, and that is why that if that has to be happened, then the rate, interbank rate, should be available for various maturity, should be available for various currency. And that was one of the features of LIBOR, because if you look at LIBOR is declared, previously LIBOR was declared by British Bankers Association for primarily around 6 or 7 different maturity, say 1 month, 3 month, 1 year, 3 year, that way, and for different currencies also. Okay, so there were around 5 to 6 currencies on which the LIBOR is declared. So it becomes very easy for you to use it, because the way the reference, this LIBOR rate was declared or created, it gives you wide variety to choose from. Okay, so it was having different tenures so that different term structure of interest rate can be created using LIBOR rate. Okay, the last three lines primarily focuses on the example. So overnight index swap. Okay, this is also an example of a swap where we use a reference rate. In a normal interest rate swap, the plain vanilla interest rate swap, you use LIBOR as a reference rate. Okay, so the last three lines just giving you an idea that the way you have the overnight index rate or the swap rate, you can use that swap rate, the rate, and create an OIC curve. Similarly, you can also create a LIBOR curve by looking by and use it for swaps, the interest rate swap. So everybody kindly read the first two bullet points. As we move towards a third point, okay, so what they're highlighting over here is, if you read the first three lines, whatever is the borrowing or the lending, that means whenever a bank raise liability, okay, through borrowing, and when they're lending, they're creating assets. Okay, so the rate should be able to reflect their lending and funding cost. Okay, when they're lending, that should give them comfort that okay, I'm comfortable to lend at this rate. Okay, when they're borrowing, that rate should also be applicable, that okay, I'm comfortable to borrow at that rate. Okay, so having a good market benchmark rate or a reference rate ease out in your process of lending, ease out in the process of borrowing. Okay, read this first three lines, and the important line is this. Read the first three lines. I have highlighted the important line. An accurate benchmark that behaves similarly to the cost of raising fund. It should not be only a reference rate. It should be applicable for bank while they're raising money from the market also. Okay, let us go to the example. Suppose a bank funds a long-term fixed rated interest rate loan with a short rated variable funding. Okay, now this short rated variable funding can be very risky for the bank, because what is going to happen if the rate of interest is going to increase, my funding cost will also go up. So generally what they do is they hedge, and swap is a very good method to hedge it. Okay, so basically, if I am a bank B and I have taken a floating rated loan outside, so generally what banks would ideally do is they will enter into a swap where they will receive the same floating rate and they will be paying the fixed. So they are converting their liability of floating rate into a fixed rated liability. That is one way to do it. Okay, that is one way to hedge the risk. So they are explaining the same part. If you look at this entire example, they're explaining the hedging part of it. I'll give you a very basic example to enhance the understanding. Now, think about this, that if I have taken a loan from the outside market at LIBOR, and when I'm entering into a swap to hedge this floating rate is on some other interbank rate, for example, MIBOR. Do you realize my hedging will not be perfect? Because for a particular maturity, for example, LIBOR is 6% and this MIBOR is 5.5%, then that will create a problem. Then it will not serve me the purpose of hedging. Hence, what happens is, if you have a swap which has the floating rate also matching as LIBOR for the same maturity, then this and this will nullify each other. So your hedging becomes very perfect. So what they're trying to highlight is that whatever is the floating rate of interest payment that you're receiving in the interest rate swap should represent the funding cost of the bank, the actual short-term variable cost that the bank is paying outside. Then only they'll be able to match the exposure. Are you guys good on the first 3 points? Can I get a quick confirmation? Simple. So these 3 points are important for the exam perspective. You can expect a theory question, okay, especially on the third point. Moving towards the shortcomings of LIBOR, okay. So they are giving you some brief background that obviously the market has moved the way we are thinking of moving away from LIBOR to some other rate. The market has already moved from the treasury bill rate to LIBOR in the history. Okay, so in the 1980s, market participants switched from US treasury bill to LIBOR. I hope you remember the US treasury bill is nothing but the zero coupon yield that you as a participant is going to generate from that particular instrument. But market participants slowly and gradually realize that this is not serving them with a true risk-free rate. This is very low. So they started moving towards the other rate, which is the London Interbank offer rate. Okay. So the primary reason they moved is that they needed a better benchmark to manage their basis risk between their asset and liability. What is this basis risk? The gap between hedging and the part. So for example, if you have taken, it simply means that whatever liabilities that you have created, okay, and whatever other part that your hedging part that you're doing, this is actually hedging. So it should match. Both of them should match. The rate of interest underlying both of them should match. So previously that was not happening. Okay, so your borrowing rate was very different, and the LIBOR rate was very, the floating rate in the hedging instrument was very different, and which created a basis risk. Basis risk simply means that your original position and your hedging position does not match. That creates a basis risk. Okay, it is like this. If you're taking an original position P is based on treasury bill, and when you're doing the hedging, you're taking a position X which is based on LIBOR. Obviously there will be a mismatch, okay, because the rates are different. That is what they want to highlight. Okay, so the first problem, the first reason primarily because they wanted to move, this because the basis risk was very high in their asset and their liability. That is one part. Second is that the LIBOR based on euro-dollar rates, euro-dollar rate level 1, we have talked about euro-dollar futures, okay, which is nothing but if you put dollars outside US banking system or outside US, they are treated as euro-dollar. So if you put money in a German bank, okay, that is a dollar into German bank, that is a euro-dollar, and whatever interest that you're getting on that money that you have kept, okay, that is LIBOR rate, okay, and that was basically the base for your euro-dollar futures contract. This futures contract was based on this LIBOR, right? So over here also, what they're trying to highlight is that euro-dollar rate, the LIBOR rate that we were looking at, that was a close proxy to banks' actual borrowing and the lending rate as compared to T-bill. Hence, market moved from in 1980s from T-bill to LIBOR. Kindly read this paragraph. So they're moving ahead, and primarily LIBOR had these two primary reasons, and hence market moved from treasury bill rate to LIBOR. But one of the major problems that happened to LIBOR, which is in 2012 itself, actually that thing was happening previously also, but nobody could identify it. That was manipulation in the LIBOR rate. And how does the manipulation happen? Okay, so previously when the LIBOR was calculated using by British Bankers Association, so every day at a particular time, if I'm not wrong, it is 11 a.m. London time. Okay, they would declare LIBOR. But before that, what they would do is they would ask all the member banks, member of the British Bankers Association. Okay, they would ask every bank to give a rate, okay, for a particular maturity. For example, if we are looking out to calculate a LIBOR rate for US, okay, US dollar for 6 months. So what is going to happen? All the banks are, say for example, Barclays, HSBC, who are actively trading in the US market, London market, and they're part of the association. So each bank will give their rate. this is the rate at which they are willing to lend money. Okay, so you have entire bucket of rates available from all the banks. Okay, if I'm not wrong, there were 15 banks. Okay, the number generally keeps on changing. So previously it was lower, 12 banks, and then I think so they increased to 15. We can cross check the number, but the basic idea is very simple. I'll take 15 as a number. What is happening over here is whatever rates you are getting for that US dollar 6 months, which has been given by the members, we'll sort it out. Okay, for example, this is the highest rate and this is the lowest rate. We will, and there are 15 rates, for example. So we'll take the top 5 and the lowest 5, and we will remove this top 5 and lowest 5 rates. Okay, whatever is the middle 5 rates, we'll take an average of that, and that will become my LIBOR for US dollar for 6 months. Okay, that is the basic process of finding for each maturity for each currency. Similarly, you can find for US dollar 1 year, US dollar 9 month. Everybody will give the rates. They will sort it out. The top 25% and the lowest 25% will be removed. We're left with the middle 50%, and we take an average of that. Okay, but the problem started happening when banks in the association, they started talking to each other, and they started saying that why don't we quote the rate lower? Everybody started giving a lower rate by default, and because of which what happened, this entire basket, it started going down, and because of which your LIBOR average, the average rate which we were using to calculate LIBOR, that will also go down. And why were these banks doing it? Because they were the only ones who were declaring the rates, and they were also taking positions into the derivative markets which had LIBOR. Okay, so suppose think about this. If I'm into a swap agreement, if I'm Barclays, I'm into a swap agreement where I have to pay floating and I have to receive fixed, then in that case, this is based on LIBOR. Okay, having a lower LIBOR helps me to generate more dollar in the transaction. So all of these banks were purposely manipulating the LIBOR rate because they had other ways to make money from this LIBOR transaction. Is everybody clear on the way the manipulation happened? The example. This was found out in 2012. The Shivam, answering to your question, was there any pre-specified upper and lower threshold? Not exactly. No. See, each bank thinks at what rate I am willing to give the money, so they will decide on their own way. Okay, so that was a manipulation. And what happened is after this entire thing came out, so they said that okay, now from now onwards, British Bankers Association will not come out with the LIBOR. We have ICE, Intercontinental Exchange. They will be releasing the LIBOR rate. So that change also happened, and a lot of banks were also got fined for their activity. Okay, so the manipulation part became a problem. Why? And this was an issue with one of our desirable properties in the reference rate, that there should be an active lending market, and that should decide the rate. In this case, that was not the reason. Okay, it was being decided by the bankers association itself. So if you read this part, they're talking about the manipulation that happened in the LIBOR submission. So these rates are not based on actual transaction. These rates were based on the bank's understanding of what should be the lending rate. So they were quoting the rate, and on the basis of which LIBOR was created. Read that paragraph. Okay, we are moving towards the interbank market rate, and suppose if we look at LIBOR, so what happened is this interbank market, okay, which we were using as a base to calculate LIBOR, okay, that market was also frozen during the 2007-8 crisis. Why? Because each bank is now thinking that the counterparty is not trustworthy, so we will not be able to lend money to them. Okay, so that's the reason the market activity became very low, and this is also a problem with respect to the reference rate, that there's no active trading happening, or active market is not available. Okay, so that created an issue. Even though we had a LIBOR, nobody was actually buying or giving money on that at that rate. Okay, so that becomes a very big issue. And this LIBOR rate, the LIBOR market, the interbank market, is unsecured market. Unsecured market means one bank is giving money to another bank without any collateral. Okay, generally this is a very short-term rate, short-term transactions that they do. For example, in US you have a federal fund rate, which is the rate at which one bank will borrow money from another bank, and these money are borrowed for very short period of time, 1 day, 5 days, few hours also. That can also be the case. Central bank had to intervene with the supply of reserve when the active lending market stopped. So when the interbank market stops, what happens is, if suppose HSBC wants to raise money, but there's no other bank which is willing to give, then they will have to move toward the central bank to raise money. And that has been highlighted over here as one of the problems that happen with LIBOR. Read that second paragraph. The third point, increased variance of individual bank credit risk post 2007. Now, why are we using LIBOR? Suppose, for example, we have calculated a LIBOR rate for 6 months, and that comes to around 3%. Okay, and please remember that this is an average rate that we have got from that entire process. Okay, and suppose if I'm HSBC and I want to give money to somebody else, and I will be using this LIBOR rate of 3%. The reason I'll be using this, okay, because I feel that the market participants also have a similar kind of risk, and this rate represents the average behavior of the bank. But suppose if the counterparty with whom you are dealing, if it has a very high credit risk, then obviously you will not be willing to give the loan at 3%. You would expect a higher rate of interest. So what happened is, after 2007 crisis, the bank's credit profile changed drastically, and because of which this average rate was not a true picture of their individual risk, and hence banks were reluctant to lend at that rate. So obviously it started losing its value. So that is being highlighted, because during 2007 crisis, a lot of banks who had liquidity issue that came into forefront, because they were raising money for a short period of time and they were investing into long-term assets. So it created a liquidity issue. Okay, and when there is an issue, obviously the credit risk is very high, then you would not be willing to give an unsecured loan at 3%. You would ask for a higher rate of interest, right? Important line is this: the next point, which highlights less risky wholesale banking funding. So when the bank started realizing, okay, that this market, interbank market, is not giving you any money, or there's no scope now because the market has freezed, the activity has been become very low, they move towards other mechanism to raise money. One of them is the repo. When we say repo, I hope you remember, it was a collateral based transaction. Okay, so your risk is reduced. It's a secured transaction, so the rate is going to be lower, and the lender's risk is also reduced. Okay, so banks started relying more on LIBOR to raise money, which they were previously relying on interbank market. Okay, kindly read this 4-point. We are moving towards the next section, reforming the reference rate. So when they realized that, okay, we should be moving away from LIBOR, they decided to identify a lot of other rates, okay, which are available, which can be used as a benchmark rate. So this entire thing is more on that discussion. So if you read this line, they were very clear that now whatever reference rate or whichever benchmark rate that we're going to be choosing, we should have an active market and we should have a proper governance arrangement on it. That means we should be sure that there cannot be any manipulation. Okay. So they went on to look for as liquid as possible rates available in the market, which can substitute LIBOR. Okay. So this is just an introductory part to this. Read that section. All good. Now, when they started looking out for the rates, they thought that ideally, whatever new rate that we're going to be putting it, we should have these features in them. Okay, these features have been highlighted over here. Mark this as star. Okay, if it is for a very shorter duration, then it is better because it is more liquid. If it is for a very shorter period, it is more liquid. Okay, so for example, an overnight rate is for a very short period of time. So it will ideally have more trading. See, think logically. If you go to the market also, you might have a rate available for longer maturity, 10-year, 15-year, but nobody generally trades at that point in time. Generally, you always see a lower maturity thing very being active. For example, in the futures market, you might have a futures transaction, a futures contract available for the coming April or August. Okay, but you might also have long-term contracts which are very illiquid. Okay, so that has been the first point, that shorter maturity transactions or rate should be used. That is one part. Second, that including we should include non-bank wholesale rate also. Okay, see these money market funds, okay, or investment fund, insurance fund, what they're saying is that we should not rely on interbank rate market also only. We should go outside. Okay, money market rate is the market where we are basically buying and selling short-term securities, bonds, which are going to mature in very early state, like for example, in the next 3 months, next nine months, that way. Okay, there might be some other market for investment funds also, commercial paper. So we can use that also. So what they said is we are not going to restrict ourselves only on the interbank market. We will look at other sources also. We'll compare it. And finally, it should be secured. This is a very important point. The reason when it is secured, okay, it obviously the rate is very low, okay, and it is not. They're comparing it with LIBOR because what happened in 2007 after the crisis, since the LIBOR rate was unsecured, the jump in LIBOR was very huge because of the riskiness in the market. That should not impact your new rate, and hence they're asking for it to be based on a secure transaction, like for example repo. Okay, and when it is based on secure transaction, your risk is ideally reduced, so it would not be impacted by the sudden increase in the credit risk or liquidity risk in the market. Okay, so read these 3 pointers, marking it as star, important. Now, when they started looking out for candidates, okay, so they had so many of them. So if you read this part, they're talking about some of the, there were these 3 pointers which we explicitly highlighted, the secure part, short-term part, and non-banking part. They started looking out for all of these features in the new competitors. So we had SOFR, we had Sonia, Esther, Tona, all of them. These are kind of rates that is being used in the market. The 5 proposed rates were available over here. Okay, and they started doing this comparison. Now, the stable is primarily available to help you understand that when they looked at wide variety of rate, only the SOFR was one which was actively helping you to cover all the 3 requirements. All the 3 requirements. So hence, it has been decided that SOFR will primarily will be replacing the LIBOR in a lot of your OTC derivative agreement going forward. Okay, whatever agreement you have already had, suppose you have signed an agreement in 2019 for next 5 years, that will stay. But the new agreements that you're going to be entering into, you will be using this SOFR rate. Okay, and this SOFR will be issued by Federal Reserve. It's basically overnight rate. So every single day the rate will be decided. Okay, I want everybody to just read this part. Most of them is very basic information. You're not expected to remember the names of the competitors. What you're supposed to remember is that SOFR was able to manage to get good points in all of the three requirements. Overnight, it should be overnight rate, it should be secure rate, it should be wholesale market rate. All good. Moving further, the same reference which has been shown in the table is also being shown over here. That when we look at all the three parameters, collateralized means secured. And there is whether it is from the wholesale market, whether it is having an active transaction based market. They've compared all the different parameters, and obviously SOFR suits in all three of them. This is just a repeat of the previous table. Nothing specific to be remembered over here. Okay. This is again connected to the table and the diagram. They are just explaining you the reference part. And one slight variation or one side point is that this rate, Sonia, which has been changed, there's been slight change over there. Nothing specific important for the exam perspective, but you should read it out so that you are aware. Taking you further, Yes, Nataraj, sir, bully.
Sir, were these rates already available in the market from a long time, or was it that they were newly formed and later on it was finalized to use SOFR?
No, they were available.
Okay. Thank you.
Yeah. So till this point, we have been able to identify that, okay, SOFR suits us in terms of the rate. But again, there will be other problems also, which we're going to be discussing in the next module. Okay. And this part of this entire section is basically comparing the three parameters, okay, with the SOFR. They're trying to say what is the case with other reference, other rates which we could have used. Okay. So if you look at the trading volume, ideally the newly proposed risk-free rate should be higher than the old reference. They're comparing and they're checking whether that was true, whether it is happening. So if SOFR has 3 times the volume of this, so it's more or less comparison. Okay, trading volume was also very high. It also increased significantly when Sonia was transformed. That means when the Bank of England changed the reference rate. So that also led to increase in the trading for SOFR. This might have happened because a lot of transactions which were supposed to happen in Sonia now happens on SOFR for that because of the uncertainty involved during that period of time. Okay, so they're checking whether the parameters that we had set out, is it actually helping us or not. That was their intention of that paragraph. Okay, now their intention was to introduce this by the end of 2019, but again these numbers were not, these dates were not fulfilled, and they led to more pushing of the release, or basically the usage of the SOFR into the market. Okay, the new reference rate are more likely to move outside the target range set by the SOFR because non-banks have no access to the central bank reserve. This is very, very important. Why? Because see, Federal Reserve is also a group of banks which are there in US. It's not like India, where every bank has to be reported or become a part of the central bank, or they need to get a proper process. And what difference it makes is that if you want immediate funding, when we say lender of last resort, central bank is able to give you money because if you're a member. If you're not a member, then you'll have to find your own way. That means that is the reason why repo as a product or repo as an instrument got very famous, because a lot of banks which were not of the federal banking network, when they wanted to raise money, they had uh, no process to go and utilize the federal fund rate, the short-term rate, because the money is transferred to their network. And then hence these banks, the smaller banks primarily, they entered into repo transaction, which is more secure and which gave them an opportunity to raise money. Okay, so that logic is being explained over here. That why SOF, what is the problem in SOFR? It might be only relevant to banks which are connected to the central bank, which are part of the central bank network. So that is being highlighted in the first 3 lines. Okay, so having a very high trading volume also represents the problem of high volatility, which is being covered over here. Mark this as star. Okay, now since this is, see again, high volatility means you might see a very huge change in interest rate. So when you're entering into contract, you might not be clear what is the next change in the contract interest rate would be, and you might, for example, if you're taking SOFR as a underlying rate for swaps, floating rate, okay, and you're paying floating, then you'll definitely be worried, right? So in that case, that created a problem because of the huge trading volume. Okay, and volatility in the SOFR the condition reflects in the collateral market and the dealer's balance sheet dressing. This balance sheet dressing means a lot of banks, what they do is they don't show their true risk in their annual reports, in their information that they pass on to. They create other banking entities, like we were creating special purpose vehicle or special investment vehicle, and all the risky assets were posted in that, so that my books look very good. Other than that, my risk is very high, but still on the dealer's bank's balance sheet or statements, it does not show. So this is called window dressing, so that your bank looks very good while raising money. Okay, so this volatility, they're trying to justify that this volatility is because of the changing market condition to collateral. If the collateral market is very volatile, it's in the sense that the value of the collateral is very changing, and since this is a secured rate, your SOFR will also change. If today you have a security which you are relying on, and tomorrow you come to know that the security is zero, then you cannot take that as a collateral, right? So definitely the interest rate which you were using, thinking that this collateral can be taken, will also get impacted. So that is the idea, that when the collateral market is shifting or it's very volatile, and there is not the dealer bank's profile is not giving you the true risk, the SOFR will also change, because SOFR will be used to get money from the market. Anusha, high volatility and active trading, these are two very different things. See, for example, if you look at the stock market, you see trading happening every single day. Okay, that does not mean there is volatility. Volatility means when the prices are moving very up and down. If today, if you go, the 6 months rate is, say for example, 3%, tomorrow it is 5%. That is problematic for us. So what they're also justifying, it is not the problem with the active market, it is problem with the collateral and the way the dealer banks are dealing. Because if dealer banks are not showing you the true risk, think about this, you're dealing with a counterparty and you're worried that whatever information that the counterparty is giving is not true. Obviously you will increase your rate of interest to compensate for that information asymmetry, right? So the volatility in the rate is basically coming from that. Perfect. Kindly read this point and give me a quick confirmation on chat.
Sir, just small query. When there is a volatility in the SOFR market, how exactly can we say that is actually also associated with balance sheet window dressing?
Okay.
Like how
So
is volatility and window balance sheet window dressing?
I'll explain you. Okay. So primarily, when we say window dressing, okay, you have to think it from this perspective that when you look at the counterparty, you're not able to understand the true risk. Okay. And what is this SOFR? This SOFR is a rate that we are going to be using to lend money. Okay. Indirectly. So when you're going to lend money at a particular rate, and if you're not sure about your counterparty's true risk, then ideally you would have to compensate yourself by charging a higher rate of interest. That is one part, right? So whenever a dealer with whom you might be dealing, okay, he is doing a window dressing, he's not giving you right information. Window dressing term represents incorrect information, or like for example, before going for IPOs, a lot of companies clean their balance sheet. So that way, so the true risk of the bank is not available to you, and hence it becomes very volatile, because instead of 3%, you might charge 5%, 6% as a rate of interest for lending, and you will see a huge volatility in the market. And also LIBOR rate, why was it good? Correcting it to the point that because the LIBOR rate was average rate. So we are saying that all the banks almost have the same risk. So it becomes very easy to use that LIBOR. If everybody is going to use their own rate, then it will create a lot of confusion, a lot of volatility in the market.
No, so that is agreed. The only small question here is therefore, so if I'm a bank and I'm getting into a trade with another bank, am I actually analyzing the balance sheet before I get into a trade and quote a rate?
Okay, so it is not exactly a balance sheet, but you do have your own parameters to understand with whom you're dealing. So what generally happens is, whenever I do any transaction with any counterparty, I will onboard that counterparty, and I will do my own due diligence, and I will do a internal credit assessment of that counterparty to see what should be the limit that should be set on these counterparties in terms of transaction.
Yeah.
Say for
Okay.
example, swap. If I'm going to enter, I will only enter till 500 million. I will not enter above that at any given point in time with the counterparty, because the risk will be very high. So
Perfect. Yeah.
they deal it for everybody. It's not only for bank. If I'm doing it for any particular company also, because a lot of these uh, other companies, they have a treasury team dealing in the market.
Yes.
So that also is taken into consideration. Let us move toward the quiz. So regulatory authorities, financial market participants are considering new potential reference rate to replace the IBOR, and have been preferred. It's more or less the same discussion since 1980. One possible reference rate is overnight index swap contract. The OIS reference rate to satisfy all the key rate of the ideal benchmark except is it derived from the actual data of liquid market? Yes. Index swap is a overnight rate every time the transactions are happening. So this seems to be correct. Is it able to offer a reference rate for financial contract outside money market? It is possible, because see, this is a rate which is an overnight rate. You can use it to calculate multiple rates also. You can use it to calculate multiple rate also. Okay, that means I can, if I'm entering into a swap for 1 year, I can take the overnight rate and I can calculate. I can create a geometric average and calculate the 1 year rate. So this seems to be correct. Is it derived from different tenure so that a term structure can be created? Like I said, you can use overnight rate to calculate a rate for different terms, 6 months, 2 year, that way. It is able to serve financial intermediary as a term lending. Okay, this is not a term lending rate, in the sense banks don't use OIS contract rate for their lending and funding. So this will create the problem which banks were facing in terms of the basis risk. That seems to be a correct answer. Okay, Darshan, I'll come to your query. 1 second. Let us go to the second question. Regulators across jurisdiction are contemplating replacing LIBOR with more appropriate references. While the major concern is exposed to manipulation, There are also other issues. Which of the following is not a cause that led to the removal? Not a cause. What do you think? Banks rely on more on less risky wholesale funding in the form of repo in response to regulators and market effort. This was one of the point. We saw a series of points. The first was manipulation. Then there was a very low market transaction after 2007 and 8, right? So that was the part. And increased variance between the interbank also. And individual banks' riskiness is very different now from the LIBOR rate. So it created a problem. So this was one of the point, definitely. The increased variance of individual bank, this was also one of the point. Interbank market became less liquid. This is also another point. LIBOR are not widely accepted as a reference rate. This was incorrect. This was actually true. LIBOR was used as an active interbank rate. Okay. So we have completed this quiz. Darshan, what is the query? OIC curve.
Actually, it's part of the second point in features of ideal reference curve. I had that query there.
This one. This one.
Yes.
Okay. So for example, if I have an overnight rate, okay. So normally what happens is if I have a tenure of 6 months, I will have rates for each day. Okay. I can take some geometric average to calculate a rate for 6 months. So similarly, I can do it for 1 year, 2 year, 6 year. So I can create the entire curve. That is what they're saying. Different maturities can be constructed. Yes.
What's the full form of OIC there?
Overnight index curve. It's the same thing. It's basically this is a swap agreement where the floating rate is the overnight rate instead of a LIBOR rate. In a normal swap, you have a LIBOR. So if you're using that OIS rate and creating the curve, that's the idea. Okay. Darshan, you had a query?
Sir, that quiz के ऊपर वाला paragraph पे. Yeah, here the second line I am not able to understand.
Second line, what they're saying is that they decided to set out in 2019, but then they moved to 2020 and then they moved to 2021. The target. When will we start doing this change?
Okay.
Let us go towards the next section, the next module. The risk-free rate in the repo market. Okay, and read this line properly. Risk inherent when we were using the risk-free rate in transactions into the repo market. So again, the discussion is going to be more on when you're using a risk-free rate or a reference rate. Okay, it should have certain qualities, but there are certain problems also which we face. So those problems are slightly discussed. Okay, so if you look at this first point, till this first 4 lines, kindly read the 4 lines. What are the features? The 3 features that we were talking about, the first page. So they are saying that the major problem with a lot of risk-free rate is that the third feature. What is the third feature? The reference rate for banks lending and funding, the basis risk part. Okay. Now relying on an overnight repo rate will not reflect the marginal cost of funding intermediary. Why? Because our funding might be for a longer period of time. If you're going to use an overnight rate to calculate the long-term rate, it might not give you the true picture of the true risk of the transaction. So that is where this problem comes into picture, that your marginal funding cost does not match with the rate. So the third point with respect to the benefit or the features that we were looking at the start, that is being challenged, that is being discussed, right? And I hope you remember the basis risk point. If your rate that you're using, the reference rate, it is not used widely, then what happens is that whatever transaction that you have outside and you're trying to hedge it, the hedging instrument will not have the similar kind of repo rate or similar kind of rate used, which will lead to a lot of basis risk. Your original position is using a slightly different rate and the hedging instrument is using a slightly different rate. Basically, the cost should match. The rate of interest which you are actually paying and the rate of interest which you're getting into this transaction in the hedging instrument should match. That is being covered. The main line is last three lines. Kindly read the same. So this creates a problem. The basis risk is again a repeat from the previous top side. Okay. If you go towards this next paragraph, they're talking about the asset liability risk, and also they're talking about the opposite direction of unsecured rate. This is basically talking about the spread. So if you remember in level 1 also we talked about LIBOR and the other rates, and they're comparing the spread OIS rate. You can also look at SOFR. See, SOFR being secured, what happens is, see, if you look at LIBOR, I'm just taking some numbers. LIBOR is at 3%, then the SOFR will be at 1%. Okay, because it's a secured rate. If there is a crisis in the market, this will go up and this will go down. This will widen the gap. Why would this go up? Because this is unsecured. So when it is unsecured, people want higher rate of interest to compensate for the increased risk in the market. And why would this go down? Because if people feel that I'm giving an asset, okay, and raising money, I will not pay 1% because there is very huge riskiness in the market. I want lower rate of interest because I'm giving you the asset, I'm giving you the protection. So the rate will go down and you'll see the spread widening. Okay, and they saw this also happening during the 2007 crisis, but there was a different behavior when we talked about Brexit, which is actually given over here. So you can read this paragraph. That they're giving you both the scenario. Rates increased for LIBOR, reflecting higher credit risk for the unsecured rate. Definitely, that's the reason the rate is going up. Conversely, the rate decreased for secured overnight rate, reflecting a collateral shortage and flight to safety. What is this collateral shortage? See, when nobody wants to give collateral into the market, and if I am willing to give you collateral to raise money, I will definitely think that why am I paying 1%? I will pay 0.75%. I'll pay 0.9%. I will ask for a lower rate of interest, right? It is similar to repo agreement. If it's a general collateral, it's a special collateral. If you're giving a very specific collateral, you'll ask for a lower rate of interest. Okay, simple. Flight to safety means most of the market participants are moving towards treasury because that is more secure. If there is a crisis in the market, when that is going to happen, it will indirectly lead to a demand for treasury as compared to other securities, right? Other corporate bonds or other commercial paper, which can be used as an asset. So what is going to happen? There'll be a kind of shortage in terms of collateral because people only want treasury. So in that case, if I'm having a treasury and I'm giving you to raise money, I will ask for a lower rate of interest. Okay. Check these last three lines are important. Read the entire paragraph. All good? Any queries? We are not assuming. I think so, Anusha. You're referring when you're saying that special collateral wala part. We are not assuming explicitly collateral shortage. See, collateral shortage is happening because nobody wants to give any collateral. They're afraid that if I give a collateral to a counterparty, he might default and I would lose my collateral. So when that is going to happen, very few people are willing to give you an asset for taking money. And that increases their value, that I'm giving asset when nobody else is willing to give. So it's not specific to special collateral. It can be a general collateral also, because nobody else is giving any collateral, their value will also increase. Okay. Yes, they will ask for a reduced rate. Taking you towards the next paragraph. Now, this next paragraph is not very important. What they are trying to highlight is they're comparing it with the other reference rate. Okay. What was their reaction when Brexit happened? Brexit was also a risky situation. It might have created a lot of other complications for banks, because now banks have to move. A lot of banks moved from UK to Germany because they also wanted to cater European Union. But because before Brexit, everything was okay. So nobody was, because it was part of Europe. So it became very easy for you to operate. But now your cost increased, your everything will increase, because you have to hire, you have to operate also from that region, from a new region primarily. The rules and regulation will be very different. So that increases your uncertainty into market. Okay. And they have given you some reference idea to that part, that some rate did not change when there was a huge uncertainty in the market. Now, why are they highlighting this? Because see, ideally you want a rate which should be stable so that market participant can use. If it is going to be very volatile during the market crisis, then it is not helping you. So they're comparing it with Sonia, which did not change much during the Brexit time frame. This is only for your reference. And the last and the final point, which we're going to be moving towards, is basically the transition. Now, people who have already done a lot of agreement, okay, see, they have an option to continue with their contract. But if the contract is for very huge time frame, say like 10 more years, okay, then LIBOR calculation might not be done for that much long period of time. Okay, so relying on like that contract or relying on LIBOR for that next 10 years is very risky for bank. So they might move, or they might transition into the new contract. They might switch. They might close the contract, old contract with the counterparty, and they might enter into a new contract. That is also going to create some uncertainty for banks. If you have a very short period of time, say for example 1 year, 2 year, then there is no problem as such. Then you can continue with that own contract. Okay. So if you read the first 3 lines, they're talking about how to move, or how to move away from that transition, because you had a lot of trillions of dollars of contract which are linked to LIBOR and still outstanding. That means still open. Okay, if your LIBOR publication ceases in 2021, okay, then it will create problem that you will not have a reference rate to calculate. Okay, and one of the possible way is to convert your original contract into new contract. So basically, they are converting floating rate cash instrument into fixed rate. This is one way to do it. You enter into one more contract which will try to negate the original contract and convert it into a new contract which is based on say SOFR or new interbank rate, which they want to use as a reference rate in the contract. So that is one way. The other way is to, your floating rate can be linked to another reference rate. That means instead of LIBOR, you will make changes in the contract and you will say that after a particular date, we will not look LIBOR, we will not look at LIBOR for a floating rate. We will look at floating rate as SOFR. That can be one way. So you make a slight change in the contract, and basis that you go ahead and continue with the transaction. That is the second point. So kindly read the first 4 lines. All good? Cross currency rate, the cross currency transactions, like for example, the cross currency swap. Now, a lot of these, lot of banks from smaller countries, they have referred to them as economies with shallow market in their own currency. That means they do not have a very active market for their own currency itself. So what they do is they rely on US or they rely on euro rate or euro currency for doing transactions. Okay, a lot of countries, their official currency is USD. Okay, so what happens is when you're relying on certain third party part, and you've already entered into suppose contract of cross currency contracts. Now moving away from the original contract to new contract can bring in more uncertainty for these economies, which they do not, where they do not have their own active market for their FX rate, and they're relying on some international rate, for example, euro and USD, to do transaction. So that would lead to more riskiness for these economies. That is covered in the last 3 lines. All good? We are going to move towards the last paragraph. What they're trying to highlight is that when we look at different variety of interbank rates, okay, whichever rate is giving you maximum benefit in terms of the feature, you should, with the most desirable characteristics, that should be taken as a benchmark rate. Okay, because everywhere you will not be able to get everything proper. So that is why they are saying that whichever is giving you the multiple benefit in one go, you should look at that, and we can do certain adjustment with respect to that rate and continue using it. So if you look at that last part, it is not clear how the implementation will happen and how the market will compromise on certain shortcomings of that reference rate. That is still not clear. But as a market, you'll have to continue and move towards a new rate as early as possible. So read this section. This is just a summary of the entire discussion. Taking you towards the quiz. Suppose a regulatory authorities and market participants agree to discontinue the publication of LIBOR into 2021. Instead, the new risk-free rate chosen to replace LIBOR is secured overnight funding rate. Which of the following statement best describe the risk of making the switch to overnight rate from LIBOR? The same discussion that we have just now done. Okay. Okay. Which is the best describing the problem? SOFR may be subject to manipulation. No, that is not true. Market volume of SOFR may not be high enough. Suppose this is not true because we talked about high volatility, high active trading happening. Financial institution will have a challenge to manage asset. This was the basis risk point. Yes, so this seems to be correct. SOFR trade do not include wholesale funding from non-bank, causing it to vary from market. Do not include. No, it's a wholesale funding rate itself. Huh? That is not correct. So the answer is C. The answer is C. So we are done with this chapter. Any queries?